Liquidity is improving, bid activity is rising, and multifamily continues to lead commercial real estate, right as policy uncertainty and a cooling white collar job market can test everybody's nerves. Now, the problem is most investors anchor to last year's fear or this year's headlines. This leads to missed entries, perhaps some rushed exits, and all around bad investment decisions. Now, in this episode, you're going to learn the three trends that matter this week, what they mean for cash flow, debt, and timing, and a simple behavior playbook to keep you on the right side of compounding. So, some big news hitting this week, and it's the week of Thanksgiving in the U.S. holiday. So, somewhat surprising to see these headlines coming out, but some good news and potentially some bad news for certain asset classes, which we are going to dive into. So, first and foremost, we are going to see an increase in the amount of debt offered by the large agencies in the United States, Fannie Mae and Freddie Mac. So, FHFA has lifted their 2026 production caps for Freddie and Fannie by 88 billion each. So a total of 176 billion total, up from 146 billion that was deployed in 2025. So some of this will work towards just creating more liquidity, right? More opportunity for some challenged operators to potentially refinance if rates continue to moderate. But one important factor here is workforce housing loans don't count against those caps. So a lot of production work that would be done in sort of workforce housing and affordable does not count in those caps. So bottom line is there's just going to be a lot more liquidity and a lot more favorable debt terms available to operators in 2026. So I sort of touched on this, but that refi relief, a big slug of that 2026 will be probably allocated towards maturities that will need an agency takeout. So that can mean some higher cap rates equaling smoother refinancing paths. Now, for deal flow, more certain debt liquidity encourages sellers and narrows some of those bid ask spreads. So, bottom line is we will have a more favorable debt environment as we go into 2026. So for operators like Faris Capital Partners, it's all about locking structures that survive rate noise, right? So fixed rate debt, underwrite taxes and insurances with strong margin, conservative underwriting will be well positioned to take down some great assets in 2026. Now, the next thing that kind of came up is we may be in a somewhat unprecedented territory here as we go into the December Fed meeting. There's some discussion about whether they should lower rates or hold. And so it's looking like for the first time, we may actually have an unprecedented tie vote at the Fed. So, policy is finally balanced and rate path expectations can lurch on new data. So this is not a lock. We're still at the tail end of November. So in December, we may see a shift. But, bottom line is as an investor, you should not be as driven by what's happening at the Fed today. In other words, it's really about does the deal work with today's rates? And if you have, debt resiliency baked in with conservative rents and expenses and multiple exit opportunities, the deal still has to work with today's rates. And so that's how Ferris Capital Partners think. It's not hoping or wishing for something to happen in the future. It's what's the reality right now and how do we protect downside risk as we proceed forward. So once again, conservative insurance and tax estimates, conservative rent estimates, and expense estimates, right? So we will see what happens in December, but it's also important to note that when the Fed decreases the rate, sometimes treasuries go up. And so Fed bank rate and the actual mortgage rate we're offered at the end of the day aren't as tied together as some might think. Now, the next piece is there has been some data to come out that recently graduating college students seeking white collar jobs are seeing softness in the marketplace. And so that could send a ripple through sort of class A urban demand, right? Because, if ultimately there's not these high paying white collar jobs in these urban centers, some recently developed class A buildings may see some challenges with lease up or maintaining occupancy. So it's something we'll be watching, which that'll lead to is some pricing shifts. Perhaps they'll lower their rents or offer longer concessions. But our theory is that with that, that'll just make those Class B assets that we invest in that much more attractive. And since our demographic tends to be more workforce, blue collar, we feel very confident that Class B will continue to perform in a way that will exceed even some of its Class A counterparts. So, for us, we like to watch all the trends. So, renewal capture rates, concession burn-offs, lead trade-outs, but you have to break it down by asset type, not just look at a market average, right? So, another piece of news that hit this week is we're starting to see the bid ask spreads start to compress. And so that's basically the gap between what the seller wants for the property and what the buyer's willing to pay for it. So bid activity climbed in October with multifamily lending as the most competitive commercial real estate segment. Now, JLL, which is a large commercial brokerage firm, has their global bid intensity index, and it showed the second highest monthly gain of the past year. Some of the drivers, of course, are these Fed rate cuts, stabilized bond markets, and more predictable debt. So why this matters is, basically we're going to see sellers with a more realistic take on what their home or their asset is worth, and buyers being willing to pay a little bit more as we've seen some relief in the debt market. So, going to be looking for some realistic price discovery for acquisition so we can take down some exceptional assets while still getting them at a good value. So, in terms of our playbook around this information, right, it doesn't really change. It's that focus on day one cash flowing B or B minus assets that we can acquire below replacement costs, and make sure we have conservative exit cap rates so we're not overestimating what we think we will be able to trade that property for. Favoring fixed rate debt with 6 months principal and interest in reserves and a 10% contingency budget on our CapEx renovation plan. And in terms of operations, continuing to move quickly, showing visible improvements as quickly as possible so we can win absorptions and renewals quickly post acquisition, and then start attacking the controllable expenses and implementing our value add plan where we can start to drive forced appreciation. So, as Andrew Carnegie is often credited with saying, 90% of millionaires became so through owning real estate. Hard assets are the thing to be looking to invest in today's uncertainty in the public markets. There's some commentary around, are we in an AI bubble? And in the past few weeks, we've started to see some volatility in the stock market. And with some of the labor data and some of the inflation challenges we're still seeing in the US, I do expect to see a soft recession soon. Now, it's dangerous to make predictions, right? But we're acting as if that's going to be the case. So we're doubling down on areas that have high population growth, strong economic growth, and economic diversity. So, in other words, more recession resistant markets. And so putting a heavy focus on those areas. Now, in terms of what we're talking about here and like how do you behave in a market where there is uncertainty, so having some investing behaviors in a sense that actually matter, right? So really thinking about the reasonable, even over the rational. Like, you don't need perfect, you just need a plan you can stick with through downturns, and build in some room for error. So making sure you have conservative debt estimates, strong reserves, so volatility doesn't force bad decisions in the future. When you have strong reserves, you have that cash in the bank for a rainy day, you can weather a few months of economic downturn, so to speak, to help you push through and maintain and continue to work on your business plan. Making sure that we're having multiple exit pathways that we've uncovered and discovered, just to make sure that we can be ready and able to take action no matter what's happening in the marketplace. And just making sure that we never take debt or execution risks that we can mitigate, right? So, no floating rate debt, once again, fixed rate debt, and a business plan that we're confident that we can execute with near perfection. So, what does this mean for LPs, for those limited partners thinking about it, investing, right? So, match the job of your dollars. Like, how do you want your dollars to work for you? Is it income or total return? And then you select the best share class that will help you reach that goal. Make sure that whatever operator you're working with, that you're asking to see their stress testing. What are their rent, expense, exit cap sensitivities? How are they looking at insurance and taxes? Are those hard estimates, or are they just making those numbers up? And even possible looking at the lender term sheets, right? And then ladder commitments over a few quarters so you can improve liquidity, because these are 5-year holds. So as you ladder your commitments, Eventually, as the business plan is executed on, you'll start to see exits come through. So you'll have your cash flow from your existing investments, and then the exited investments bring in that more higher return. So bottom line is liquidity is improving, policy is still uncertain, and bids are rising, right? So exactly the moment to buy with discipline and not headlines. Now, if you've really enjoyed what you've heard in this episode, please go to fulloutinvesting.com, where you can learn a lot about what we do here at Faris Capital Partners. We have a sample deal deck and a video explaining our full out acquisition process. You can also book in a time to connect to learn more. Thank you so much for tuning in. We love and believe in you. Keep dreaming and investing big. And if you've loved this content, please like and subscribe and share with another high net worth investor. Have a great day.